Hey, what's up guys? Welcome back to the channel. My name is Frank Mularcik, and in this video, we're going to be looking at a few dividend stocks that I think are at pretty fair valuations or maybe even undervalued right now in this current market. Definitely a lot of volatility going on the last week or two, and I expect a lot of volatility continuing over the next few weeks as things continue to play out with interest rate hikes coming soon, and also, obviously all that foreign policy issues that could come up with Russia, Ukraine, that whole situation basically. So these are some companies that are pretty solid dividend companies in my opinion. And I think right now they're at a pretty good level to be buying. So the first one we're going to be talking about is Leggett & Platt. And so if we come into the computer here, we can see right now their dividend yield is right around 4.5%. And they have been growing that dividend for over 25 years. So they have a super consistent track record of paying that dividend. The one thing that isn't as good about Leggett & Platt is their dividend growth rate over the past 5 years is only around 4%. So they're really not increasing that dividend all that much. In 2021, they increased it by about 5%. So pretty much right in line there. In terms of earnings, they have been growing their earnings generally, up and to the right. It's not super consistent, but at the same time, they are sort of a consumer cyclical type company. So there's going to be, cycles of ups and downs, and that's kind of what we're seeing here. And right now the PE ratio is actually right around 12, which is pretty attractive. And if we kind of compare it to their overall industry that they're in, this furnishings, fixtures, and appliances industry within consumer cyclical sector, we can see the average for the industry is around 14.5. So Leggett & Platt right here is a little bit below that, which is definitely good to see as well. And then the last thing we want to look at is kind of a little bit of a chart just to check it out. And we can see over the past 8 months or so, this is about a 1-year chart. So over the past 8 months, they've really been trending down. And I think right now is really a pretty decent time to be buying in terms of price. And even if we go out maybe 2 years, I guess you can't go out 2 years, but we'll go out 3 years, and I think if we go back here a little bit, it looks like that's about as far out as we can go. So this is about a year and a half worth of chart, and if we go back a little bit further, we can see during the crash of 2020, March 2020, they got here around $22 per share, but even the current share price of around $37 is right about here. So they that was kind of in the middle of the crash. So I guess my point is that they are well below those pre-pandemic highs. And so from my perspective, that's a pretty good time to be buying. So next company we're going to be looking at is 3M. So this is in the industrial sector, and they are a super solid company. And if we look back on the chart, maybe even like 5 years, we can only look at the 1 week chart, but just looking back that far on the chart, this basically goes back to March of 2017. We can see they've kind of been in a downtrend even before the March 2020 crash. They were in a downtrend, and then they rebounded some after rebounded in 2020, and now they're kind of on a downtrend again. And they've been going down pretty steeply actually the last few weeks or so. So that's definitely something that I think is at a fairly decent spot for 3M. And right now, actually, the RSI is way down here around 35. So that's a pretty good opportunity in sort of the short term. If we look here, they're in the industrials sector, and then I think they would just be in the conglomerates industry, if I recall correctly. So yeah, they're right here. And so their current PE ratio is around 15, and the average for this sector or this industry is around 35. So, which seems a little bit high, and it might just be because of some of these outliers that have rather large PE ratios. But, overall, I think the PE ratio for 3M shows, a pretty decent discount compared to some of their peers. And if we look historically, it's definitely in line with where they've been over the past 5-10 years. So I think that is a good sign. And if we look at earnings growth for 3M, it's really consistent. Not super quick, but really consistent, much more consistent than Leggett & Platt, which is a good thing to see as well. And looking at the dividends, the current yield is sitting right around 4%, just below 4%, and they have been growing that dividend for over 60 years, which is fantastic. The dividend growth rate over the past 5 years, around 5.5% again, so not super awesome. And one of the really disappointing things for me about 3M is that the past like 2 years, they've only increased the dividend by like 1% or maybe a little bit less. So I really hope they start to increase it a little bit more over the next few years. We'll just have to see how that plays out. And if I'm going too fast for everyone, I hope that's not the case, but I'm trying to get through as many companies as I can without making the video super long. So that's why I'm kind of trying to go quickly through this stuff while still providing a lot of information. So the next one we're going to look at is Store Capital. This is a REIT. I actually made a video just a few weeks ago on this one. Right now, their dividend yield right around 5%. And they've only been growing the dividend about 6 years, but that's basically the entire time they've been public. They're a pretty new company, which is part of the attraction for me to them, because they have an opportunity to really grow pretty rapidly, and so that's something that I'm looking forward to. And they have been growing the dividend around 6% per year, which is a little bit better than the other companies we've looked at. And for a lot of REITs, I think that's a pretty healthy amount. And we're not really going to look at PE ratios for Store Capital because that's not as it's just not as important or not as vital. It doesn't really tell you as much about the health of the business, so we're not really going to look at that. But they have had about 5% growth per year in their adjusted funds from operation, which is something that you often look at with REITs. And the current price to AFFO ratio is around 15, which is definitely from what I looked at, it's about right in line with the sector and probably a little bit lower than most of their peers in the sector. So I think that's a good sign. And if we look at the chart, they're sort of in a similar situation with Leggett and Platt, where they've just been kind of trending down over the past few months. And right now they're down here around $30 with a RSI. Looks like RSI is around 40, maybe 40 or 50. So, in the short term, I think it's definitely a good opportunity, and longer term as well, for those reasons. And actually, if we go back a little bit further, I want to try to find this gap here, because there is still a gap, I believe. I'm not exactly sure where it was. Maybe it was right around here. I'm not positive where it was now. But oh yeah, it's right here. So there's still this gap right here that's basically never been filled. And oftentimes that's sort of a symbol or a sign that eventually, gaps tend to be filled like that. So we can really expect it to come down here to the $27, $28, $29 level sometime soon. Well, not necessarily soon, but at some point. And you see we got down here to around $29 per share. So I think if we see some more red in the market, Store could definitely drop a few more bucks fairly easily. So that's definitely something to be cautious of, but at the same time, I think the current valuation is pretty solid, and I have definitely been buying some of this company over the past few weeks. And the last one we're going to look at in this video is Air Products and Chemicals, ticker symbol APD. So this is one that is in the materials sector, and I've been buying this one for the last year or two. But they're actually kind of volatile if you look at it. If you look at this chart, so I think when I started buying was right around here in the 230 range, 230 or 240 in the summer of 2020. And I started buying there, and then they jumped up a ton, and I was super excited. And then they've kind of traded sideways and up and down since. So right now they're sort of back in that 240 level where I started buying them. So that has definitely been exciting for me, and it's been an opportunity for me to buy more shares. And you can see the RSI is pretty much oversold, I would say, around 29, 30, 32, something like that. And if we look at some PE ratio metrics here, they are in the materials sector within the chemicals industry. And if we look down here, their PE ratio right now is around 25, which I would say that's the least attractive metric for them right now, is the PE ratio. But the average, it says, for this industry is around 35. So really, compared to the industry, they're definitely at a little bit of a discount. And if we look at sort of their history of their earnings and PE ratio, we can see they have some pretty steady earnings here. Not really all that fast of earnings, but very steady nonetheless. I'm not exactly sure what happened these few years here where they had that big spike, but regardless, the PE ratio has, been in the 20 to 25 range over the past 5 or 10 years. And now again, we're sitting right around 24 and a half. So I think that's really not that bad for APD. It could definitely be a little bit better. I would like to see, I think, a little bit more earnings growth, but at the same time, it's a lot better than their earnings decreasing over time. So as far as the dividends go, the current yield is under 3%. So I think this is the lowest yielding one we've looked at so far today. But the good thing about this one is that they grow their dividend a lot faster. So over the last 5 years, they've grown the dividend around 12.5%. I know they announced a dividend increase just a few weeks ago that was around 8%. And I remember the dividend increase they announced in 2021 was around 11 or 12%. So, 10% is super exciting for me, anything above 10%. And if they can continue to do that consistently, that's really going to provide some awesome dividends and awesome returns for us as shareholders. And they have been pretty consistent with those dividend increases, raising the dividend over 39 years consecutively, which is pretty awesome to see. So those are the companies I wanted to talk about today. I'm probably going to actually make another video similar to this in a week or two with some more. I have a few more on sort of a short list right now, and hopefully I might be able to add more to that list over the next week or two, and I guess we'll see what becomes of that. But let me know what dividend stocks or blue chip solid companies you guys have been buying over the past few weeks. There's definitely been a lot of good opportunities, and I'm always looking to find more opportunities and more places to deploy my capital that I think will, be a awesome way to generate even more capital long term. So thanks for sticking around to the end of the video. I really do appreciate that, and I would love to hear any comments down below, and I will see you guys in the next one.